Markets on edge as Ukraine crisis escalates further. Asian stocks trimmed intraday losses at the start of the week on a report that a proposal for a summit between U.S. President Joe Biden and Russian counterpart Vladimir Putin has been accepted by both sides. While China's Shanghai Composite and South Korean Kospi finished just below the opening levels, Japan's Nikkei 225 fell nearly 0.8% after the data showed that the country's manufacturing PMI dropped from 55.4 to 52.9 in February, below the expectation of 55.0. In Europe, after a mixed to negative start to the week, equities saw sharp losses on Tuesday to hit a 7-month low during the session, with the Pan-European Stock 600 index falling 1.7%, its fourth straight session of losses. On Tuesday, Wall Street stocks closed lower as geopolitical tensions continued to escalate after Russia sent forces into Ukraine's eastern regions. In turn, Germany decided to halt certification of the Nord Stream 2 pipeline, while the UK imposed sanctions on several Russian banks and individuals. As risk aversion intensifies amid these developments, the S&P 500, the Dow Jones, and the Nasdaq fell 1%, 1.4%, and 1.2% respectively. Asian equity markets, however, managed to rebound on Wednesday, with investors monitoring developments on the geopolitical front after Biden announced measures that target Russia's sale of sovereign debt abroad. China's Shanghai Composite was up 0.93%, Hong Kong's Hang Seng gained 0.60%, Australia's ASX 200 rose 0.62%, and Japan's Nikkei was closed for the Emperor's birthday. In Europe, stocks closed lower on Wednesday as geopolitical tensions remained elevated after Putin ordered his forces into Ukraine to secure Donetsk and Lugansk rebel republics. Elsewhere, Barclays beat expectations as full-year net profit quadrupled in 2021. The British lender's shares gained 2.65 following the report. Germany's DAX 30 fell 0.42% after the data showed that the GfK Consumer Sentiment Index from Germany came in at negative 8.1 heading into March from negative 6.7 in the previous month. U.S. stocks fell on Wednesday with concerns over the Ukraine crisis pushing the S&P 500 deeper into correction territory. Global risk aversion intensified after Ukraine declared a state of emergency and began to mobilize reservists, calling on its citizens to immediately leave Russia. As such, the Dow Jones Industrial Average fell 1.4%, the tech-heavy Nasdaq Composite retreated 2.6%, and the S&P 500 plunged 1.8%. Following mixed dynamics in the first half of the week, the dollar resumed the ascent versus high-yielding counterparts on Wednesday due to its safe haven status as risk aversion intensified. The euro-US dollar failed to regain the 1.1400 figure and came back under renewed pressure to get back below the 20 DMA and the 1.1300 figure to notch late January lows just above the 1.1200 figure. Asian stock markets plunged on Thursday after President Vladimir Putin announced Russian military action in Ukraine. Putin said that the military operation was needed to protect civilians in eastern Ukraine. Ukrainian President Volodymyr Zelensky announced a countrywide martial law. Hong Kong's Hang Seng Index declined nearly 3%, Korea's Kospi dropped 2.6%, Japan's Nikkei 225 lost 1.8% after coming back from a holiday. China's Shanghai Composite moved 1.54% lower. Amid these developments, trading in the Moscow exchange has been suspended, and the Russian ruble on the interbank market fell to a new record low against the dollar. In the oil market, geopolitical tension news triggered a rally towards the $100 figure on Thursday. Brent crude jumped to fresh multi-year highs around $99.30 and could easily derail the psychological level as the situation surrounding Ukraine keeps deteriorating, fueling supply-related concerns in the market. Later today, the U.S. will release the second estimate of fourth quarter GDP data, the weekly initial jobless claims, and January new home sales. However, investors will remain focused on headlines surrounding the Russia-Ukraine conflict. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.